In 2022, the United States froze $300 billion in Russian sovereign reserves overnight, not Russian citizens' money, the Russian government's money, held in Western banks, gone in a single decision. Every central bank on earth watched that happen, and every single one of them quietly asked the same question. If it happened to Russia, what stops it from happening to us? What came next wasn't panic. It was something more dangerous, a slow, deliberate, and largely invisible repositioning. And right now, you're watching the consequences of that repositioning play out in real time. In the oil market, in the gold market, and in the quiet decisions of the world's most powerful financial institutions. Most people are missing it entirely. Here's what's actually happening. If you've never heard this framed this way before, drop a comment below, because most financial channels aren't connecting these dots. And make sure you hit like so this reaches people who need to see it. To understand where we are, you have to understand a deal that rebuilt the global financial order after it collapsed in 1971. When the United States ended the gold standard under Nixon, the dollar lost the one thing that had guaranteed its global value, a fixed link to something real. The system needed a new foundation, and it found one in oil. The arrangement wasn't formal. There was no treaty, no public ceremony. But the deal was straightforward. Oil-producing nations, led by Saudi Arabia, would price their exports exclusively in dollars. In return, they'd get U.S. military protection and access to American financial markets. It was elegant, and it worked. Here's why it was so powerful. Every country on earth needs oil to run an economy. If you need oil, you need dollars first. That created permanent structural global demand for the U.S. currency regardless of how the United States managed its own finances. America could run deficits. It could pile on debt. It could do things that would sink any other currency, because the world had no choice but to keep buying dollars. That system is called the petrodollar. And for 5 decades, it quietly funded American dominance. The question worth sitting with right now is this. What happens to everything built on top of it when the foundation starts to shift? If this is the first time you're hearing the petrodollar explained this clearly, share this video, because what comes next is where it gets serious. Most people have no idea this is already moving. Here's the mechanism that most financial coverage completely ignores. When oil is sold in dollars, those dollars don't just sit in a vault in Riyadh. They get recycled, mostly back into U.S. Treasury bonds and American financial assets. This is called petrodollar recycling, and it's one of the least discussed but most important forces in global finance. Think about what that means in practice. Every barrel of oil sold anywhere in the world generates a small but consistent bid for U.S. government debt. Multiply that across millions of transactions across 50 years, and the effect on American borrowing costs is enormous. The petrodollar didn't just benefit the U.S. in theory. It kept interest rates lower, deficit spending cheaper, and the dollar stronger than it had any right to be on pure economic fundamentals. Now here's the part that should concern you. OPEC's most recent moves, and the specific signals differ slightly by member state, but the direction is consistent. Point toward a growing comfort with settling oil transactions outside the dollar. Saudi Arabia has held serious discussions about accepting yuan for Chinese oil purchases. The BRICS bloc, which now includes major oil producers like the UAE and Iran, has added institutional momentum to what was previously a fringe idea. None of this means the petrodollar ends next quarter. That framing misses the actual risk. The real risk is what happens to the recycling loop when it starts to fragment. If oil trade migrates toward yuan, toward bilateral currency deals, toward anything other than dollars, the automatic bid for U.S. treasuries weakens. America has to find new buyers for its debt, at a time when its fiscal situation is already raising serious questions. That's not speculation, that's arithmetic. And here's what makes this particularly hard to see coming. It's not happening through a crisis. It's happening through 1,000 individual decisions, each one rational in isolation, but collectively pointing in the same direction. Go back to that $300 billion. When Washington froze Russia's reserves in 2022, it wasn't just a sanctions decision. It was a demonstration, and not the kind America intended. It proved in the most visible way possible that dollar reserves held in Western institutions are not unconditionally safe. They are subject to political risk in a way that no other reserve asset is. That realization landed very differently in Beijing than it did in Brussels. It landed differently in Riyadh than it did in Ottawa. Because the countries watching most closely weren't U.S. allies who felt reassured by the move. They were sovereign actors who suddenly saw their own reserve portfolios in a new light. Gold holdings don't freeze. They don't get sanctioned. They can't be blocked by a foreign government's policy decision. For a central bank managing reserves in a world where geopolitical relationships are increasingly unpredictable, that property shifted almost overnight from theoretical comfort to practical priority. The response was immediate and measurable. Central bank gold purchases hit their highest levels in decades. The World Gold Council's data shows net purchases running at historically elevated rates since 2022, with the trend accelerating rather than reversing. These are not retail investors buying gold on a fear trade. These are sovereign institutions with currency management responsibilities and political accountability, making deliberate, calculated decisions about the long-term composition of their national savings. This is the question you should be asking. When the world's most sophisticated and least emotional investors start moving in the same direction simultaneously, what do they know that the mainstream narrative isn't saying? This is the part most people never connect. If this reframed anything for you, share this with someone who needs to understand what's actually moving in global markets right now. Here's what ties all of this together, and why gold is the signal worth watching most carefully. Gold is the only reserve asset on Earth that belongs to no nation's balance sheet. It carries no counterparty risk. It can't be printed, diluted, or politically weaponized. In a world moving toward genuine currency multipolarity, where the dollar remains important but no longer unchallenged, gold functions as neutral ground, the asset that doesn't take sides but holds value regardless of which currency arrangement eventually gains more traction. That's not a new idea. It's actually the oldest idea in monetary history, and right now the world's most powerful sovereign institutions are rediscovering it. Consider what's happening in the Gulf specifically. Saudi Arabia and the UAE have built massive sovereign wealth funds denominated heavily in dollar assets. They've benefited enormously from the petrodollar arrangement. But as their trade relationships with China, India, and Southeast Asia deepen at a pace that has no historical precedent, dollar intermediation starts to look less like a foundation and more like friction. When your largest trading partner uses the yuan, settling in dollars means an extra conversion step on every transaction. That sounds like a small inconvenience. Across trillions of dollars in annual trade, it becomes a structural incentive to find alternatives. So here's the scenario that mainstream Western financial analysis has been slow to take seriously. As Gulf states accumulate yuan from oil sales to China, they face a problem. Chinese financial markets don't yet offer the depth, liquidity, or legal reliability of U.S. capital markets. The yuan doesn't recycle the way petrodollars did. So what fills that gap? Gold. Liquid enough to be meaningful at sovereign scale, politically neutral, and uniquely suited for a world where you need to maintain credibility with both Washington and Beijing simultaneously. And gold is one of the few assets that doesn't force a geopolitical choice. The British pound didn't lose its reserve status in a single crisis. It lost it across decades, 2 world wars, a shrinking empire, persistent deficits, and the slow rise of an alternative that was better positioned for a changing world. By the time the dollar's dominance was formally acknowledged, the transition had already been underway for a generation. History doesn't repeat exactly, but the structural logic rhymes. What's happening today is not a dollar collapse. That framing is too dramatic and too simple. What's happening is a slow, measurable shift in how sovereign actors think about currency risk. And within that shift, certain assets are being quietly repriced. Gold is one of them. And it's telling you something that the headlines aren't. So what does this actually mean for you? The practical point isn't to predict which scenario plays out. It's to recognize that the range of outcomes has widened, that the assumptions underlying the post-1971 monetary order, the assumptions baked into your savings, your bond exposure, your currency holdings, are being actively questioned by the very actors who built and benefited from that system most. The dollar isn't collapsing, but it is being stress tested, and the world's most informed, least emotional participants in global finance are responding, not with panic, but with deliberate, quiet repositioning. The most important thing to understand about major monetary transitions is this: they don't announce themselves, they accumulate. And by the time they become obvious in the headlines, the smart money has already moved. Right now, those two things, what the most sophisticated institutions are doing and what the mainstream narrative is saying, are not the same. If this gave you a framework you hadn't seen before, subscribe for daily updates, because this story is still developing and the next signal in it is already forming. We'll cover it before it becomes obvious.